Welcome back, ladies and gentlemen. You're watching India Tonight with me, Sumita Karir, and my colleague Shibani Gharat. Let's now take a look at some budget-related stories that are coming in. Well, ahead of the budget, let's in fact get your very important voice from the financial sector to understand what the sector wishes from the centre. We are joined now by Keki Mistry. He's a former Vice Chairman and CEO of HDFC. Keki, thank you very much for taking the time out and speaking to us here on ET. Now, first things first, what are the key goals and challenges that the government must address as far as this budget is concerned, the budget 2026, which is just days from when we're talking?
All right. So in my opinion, the budget this year will focus around 5 or 6 pillars. So let's understand what those 5 or 6 pillars will be. I think the first will be growth. In a country like India, we need to continue having this momentum of 7-ish% growth year after year. So growth momentum should continue. Second focus, in my view, would be on employment generation. We have a young population. 2/3 of our population is below 35 years of age, and we have a large number of people, large number of students who pass out of schools and colleges every year, and we have to therefore ensure that there are enough investments happening in the economy, which in turn will generate jobs, and these students will get jobs when they finish their graduation. The third pillar, to my mind, will be consumption. What is it that needs to be done to further increase consumption? We had tariffs that came in the course of last year. Tariffs would have had some impact on export of certain items like gem and jewelry, textile, and a few others. But because of the reduction in the GST rates that were done in September, we've seen a massive pickup in consumption. So we have to continue the momentum in terms of further increase in consumption. So that should be the third pillar. The fourth pillar, to my mind, will be manufacturing. Even today, our manufacturing base is not as high, as strong as it could perhaps be. So we have to find ways of giving some further encouragement so that more people invest back into the economy, build factories, build manufacturing units, generate jobs.
Keki, also help us understand, do you expect the budget to flag in narrowing fiscal deficit? What, in your view, will be the budget stance on government borrowing for FY27?
I won't be able to quantify the amount, but I definitely think that the finance minister would continue to follow the path of fiscal prudence and reducing the fiscal deficit. It might be a small 10 basis points or whatever, but there would be some move towards reducing the fiscal deficit. Reducing or at best maintaining the fiscal deficit, not letting that go higher.
Right, Keki, but rupee bond yields have once again started to rise in the recent past, even though RBI cut the policy repo rate in December. What signals should lenders pick from the recent increase in debt yields?
We can't look at these things in very short periods of time. We have to look at this in an extended period of time. You see, there are various factors which come into play. Like, for example, foreign exchange. Now, if there is a lot of volatility in foreign exchange rates, then typically you would find that central banks come to the market, purchase dollars or sell dollars in order to stabilize or to smoothen the path of the rupee, of the currency. So that could be at play. Another factor could be at play would be taxes. We have advanced taxes, first installment, second installment, third installment. So money gets collected by the government. A huge amount of money moves out to the banking system, goes into government coffers, and it takes the government some time to spend that money. So in that intervening period, liquidity could be a little tight, interest rates could go up a little bit, and so on and so forth. But given the very low level of inflation that we're having today, the last print was, I think, 1.7% or something. Given the very low level of inflation, I think RBI will ensure that there is enough adequate liquidity in the system without really going overboard in terms of too much of excess liquidity. But there will be adequate liquidity maintained, in my view. And these interest rate movements are, to my mind, temporary. They don't necessarily indicate a trend.
Keki, what are your expectations regarding budget measures on boosting consumption? If you can tell us more on that as well.
Look, I don't know what would be done for boosting consumption, but consumption increases when incomes increase. Consumption increases when the amount left over with people after paying taxes increases. What I would advocate for improving consumption, in my opinion, I'm not saying that is what will happen, is that we used to always have a peak individual tax rate of, let's say, around 30%, 31% in the past. We've taken the tax rate up to about 39.6% or almost 40 odd percent. So we have to find possibly cap the maximum marginal tax rate to, let's say, 35% or 30%, so that there is more investments, there's more money left with people. That money gets consumed, spent, or that money gets reinvested back in the economy, and the reinvestment in turn will create more jobs and will give further employment and therefore further boost to the economy. So lowering tax rates, whether it is income tax maximum marginal rate or it is GST rate, will certainly boost consumption. Job creation will boost consumption. So, we need to also find ways of encouraging reskilling of employees. Today, we've not yet seen the impact of artificial intelligence, but over the next 2-3 years, we can see quite a significant impact coming through artificial intelligence in terms of jobs. So we have to encourage reskilling. All companies should be encouraged to reskill their employees so that you don't see any impact of artificial intelligence on jobs.
Right, Keki, but what is your outlook for demand for home loans and interest rates on mortgages, especially after the December policy rate cut by RBI? And are you expecting another rate cut to come in from RBI in February?
All right, I'm not expecting a further rate cut for the moment in February. Of course, things could change and you could perhaps see one, but at the moment, I don't expect a rate cut to happen. And the reason I don't expect the rate cut to happen is simply because of the fact that inflation is low at the moment, but the base effect is getting lower and lower with every month. And if the base effect gets lower and lower, cosmetically, artificially, your headline percentage number will become higher because it will be divided by a smaller base. So therefore, RBI will be very cognizant of that and may not want to reduce interest rates and create some amount of unnecessary inflationary pressure. So at the moment, I don't see interest rates coming. Home loan rates follow interest rates. Today, every loan is linked to an external benchmark. So if the external benchmark has come down, obviously home loan rates will also come down. Encouragement for housing, this government has done a tremendous amount for the housing sector, right from 2014 till now. In 2017 or 2018, there was a scheme of the government called Credit-Linked Subsidy Scheme, under which if you were a first-time home buyer and you were eligible, there were certain eligibility criteria, and you were a first-time home buyer, did not own a house, then you were entitled to some amount of subsidy, which was paid by the government to the institution which was lending you money for buying a house. And that created a big spurt in demand for housing in that period, particularly the low-cost housing. Something like that could get reintroduced because housing is a very big employment generator. Housing creates jobs not just directly in terms of construction workers or engineers or plumbers or whoever, but it also creates massive amount of jobs in affiliated industries like cement, steel, paint, power, and multiple other industries which make those nuts and bolts which are necessary for constructing a house. So some incentive for the housing sector through some subsidy scheme is, to my mind, a possibility.
Also tell us, do you expect the finance minister to touch upon consolidation in the banking sector, especially the public sector banks?
I think the last time they did it, it went very well. We could see some of that happening in this budget, but it doesn't necessarily have to come through a budget. This is something which can be announced by the government at any point of time. But some amount of consolidation could happen in the public sector space.
Well, thank you very much for your inputs, Mr. Keki Mistry, and we appreciate you taking the time out and speaking to us here on ET Now on the upcoming budget and your expectations, especially as far as the banking sector is concerned. Thank you very much once again. And ladies and gentlemen, it's now time for us to slip into a short commercial break. We come back with lots more on the other side of India Tonight.